My name is Ron Lake. I'm from Lake Partners. I'll be today's moderator of what is the third in a series of forums that have been sponsored by Cantor Fitzgerald. I want to thank Steve McMiniman for hosting this series of events. Today's topic is the art and science of arbitrage. I was driving over here this morning listening to the radio, and I heard that Angelica Houston, the actress, was interviewed, and she was asked what she thought of the Yankee game last night. She said, "I'm sorry, I don't follow football." And it made me think that that actually had a lot to do with the art and science of arbitrage, because there are always players in the markets who leave behind information. It's not important to them, but it's important to somebody else, and as a result, that information has value. And the arbitrage business, I think, you guys will tell you, revolves around that art and science of exploiting information, some of which crops up episodically, perhaps that's the art side of it, and some of it crops up systematically, perhaps that's the science part of it. So I'll leave it to our two panelists to delve into the insights of what that art and science really involve. Our first speaker will be Fred Greene, who's been in the investment business for over 26 years now. Originally, he started his Wall Street career at Kidder as a portfolio strategist, and then joined Goldman Sachs, where he was a senior portfolio strategist. In 1980, he formed his own company, Westchester Capital Management, which manages merger arbitrage programs for wealthy individuals and institutions. He also runs what is the only mutual fund focused on merger arbitrage called the Merger Fund, as well as several partnerships and offshore companies. Our other panelist is Myron Scholes, who is a principal and co-founder of Long-Term Capital Management, which specializes in the development and application of sophisticated financial technology in investment management. He is the Frank Buck Professor of Finance at Stanford, and was formerly managing director at Salomon Brothers, where he was co-head of the fixed income department and the trading of derivatives and sales. He is the co-originator of the Black-Scholes options pricing model, which is the basis of pricing technology that's used to trade derivative instruments around the world. So on that note, let me turn it over to Fred, who's going to talk about the art and science of arbitrage from his point of view in the merger area. There's a handout which you'll get. Please, as we proceed here this morning, breakfast is being served, I guess, as we speak. And after both of our panelists make their presentations, we'd like very much to open it up and conduct this as a forum with some give and take. Please don't hesitate to ask questions. Myron, the art and science of arbitrage, what's your perspective?
Well, I think I can sum it up in a few words that by looking at all of you eating breakfast, you're arbitraging against a zone diet. So the balanced American diet of having requisite protein and carbohydrates, because it's 100% carbohydrates essentially. So all of us arbitrage all the time, is what I'm trying to say in terms of our stock selection and our own portfolios we tend to hold. In thinking about talking today, I thought it would be sort of best to use my own firm as an example of what we do, because I think that arbitrage is so broad a word, unless we're 100% of us are invested in a world portfolio that's completely indexed. We're all doing arbitrage of some form or other at all of our lives. So when we talk about, I'm with a firm called Long-Term Capital Management, which is has one of its offices up the street here on Steamboat Road, and our focus may be completely different from a focus of lots of other firms. It's obviously completely different and the focus we heard just a moment ago. Basically, it depends where you start off. I mean, many arbitrage firms have people who are just people, and basically what they have their own expertise in doing is what they try to do, and if they can do it more efficiently than others, they'll add value for all of us. We started off with thinking that we could apply and develop sophisticated financial technology and really apply that technology to the bond area. Essentially, bonds were great. They had a contract that told you what you got paid off, and it told you what a date with destiny was. Stocks, a little bit more amorphous. You have a management, and they tell you certain things, but they're sort of infinite lies to the firm, and it's much tougher to use sophisticated technology to value those particular securities. So we have tended to focus more on debt instruments and contingent claims type instruments, which again have boundary conditions, depend on payoffs of other assets. Initially, we started our firm. We weren't going to necessarily just apply our technology and our way of thinking about problems, and to only do it for a fund, but our first venture into the application of this technology. And when I talk about technology, I don't mean in a very narrow sense of mathematical technology where you have a model. We have lots of models. We have models of the term structure of interest rates in various countries, and we have models of contingent payments on mortgages, and we have on refinancing of mortgages, and we have models on capital structures of firms. But we also have a great belief in sort of understanding the institutional rigidities and regulatory rigidities which create also opportunities. And so we try to marry, and trading experience, we try to marry these together to affect a better product than just a black box model approach. Models are tools. What you know is tools. Who you know are tools, and using them efficiently is quite important. We have actually sort of targeted higher returns for the risk that we're undertaking, and for investors, high net worth investors and institutions around the world. And we tend to want to run our fund at a zero correlation with known indices. One of our clients has an advisor, Bill Sharp, who some of you might know has these style analyses, or saying that even though you postulate your one style, that when you look at managers, they have other styles that they sneak in. And so he had data from his client as to our performance since our inception in early 1994. And he gave me a good compliment. He said, "We're stylists. We have no style at all," which is exactly what we want. We don't want to be correlated with any index. So if the stock market goes up, we could just as likely go up as go down, and vice versa. Or if the bond market should change, we would do the same thing. So being uncorrelated is what we had said we would provide investors. So most of our strategies, it's just really the application of finance theory on a global basis, because we're doing a lot of relative value investment strategies around the world. I guess basically the simplest way to think of that is if we think something is undervalued, say we thought that, just to give you a stock analogy, if you thought IBM was undervalued for particular reasons, and you bought IBM, that not only would you be buying IBM, but you'd be buying the general market factors that IBM was also subject to. So you had expertise about IBM, and holding IBM, you'd also be betting that the market would be going up in general, because IBM is pulled up by the level of the market or pulled down by the level of the market, regardless of whether you think IBM is a terrific buy or not. And so generally we say the same thing. If we think IBM is a terrific buy, by way of analogy, that we would buy IBM, but we don't have necessarily any view of what the stock market is going to do. So we would sell the stock market or sell futures or swaps to get out of the risk of the stock market and just leave ourselves with the risk of investing in IBM. That's what we sort of know, or thought we know, according to our models by way of analogy. And then since we've so reduced our risk by selling off the market factor or other factors that are systematic, then we've reduced our risk quite dramatically. And so then we say, well, we know what we know about IBM, and if we just held IBM outright, we'd have market risk and idiosyncratic risk. Now we just have idiosyncratic risk, so let's really magnify our bet on what we know. And so we lever what we know. We lever what we know, we don't lever what we don't know. So if we're correct, even if we lever it just by way of analogy, if we levered ourselves up to exactly the same level of total risk that IBM had by owning it outright and hedging the systematic component, what we have done is we have achieved the same risk, but we now have bet where we know something about, not what we don't know something about. And if we're correct, we'll magnify our returns or magnify our degree of correctness. So that's very important to us. So if we look at bonds and we have a term structure model, we look at the U.S., which is a very efficient market, that what we do is we say if we have a rational pricing curve for estimating the value of bonds along the term structure, and we see there's a mispricing, and we deem there to be a mispricing, we would buy the bond that we thought was undervalued, and we sell other bonds or futures or swaps so that we could hedge out those risks, the market movements and other factor movements that we don't want to take. And so if, for example, you buy one bond and sell another bond, you have basis risk essentially. And so levering that creates a great rate of return for you without having commensurate risk of taking things that you don't have any expertise in forecasting, such as the level of interest rate. So I like to claim that our type of strategy is just sort of picking up nickels, but using a vacuum truck to pick them up. So that's just a difference in style that we have. I mean, other people are global asset managers in the sense, global or macro manager in the sense that they forecast the change in interest rates, and they do a terrific job at it. We don't tend to do that unless we can think that there's such a great opportunity that we can get consensus of all of us to undertake those types of strategies. We currently manage about $5 billion in we have assurance money, or money in the equity. I don't know how you want to call it, around $5 billion, and our assets in a conventional sense are over $120 billion. Off balance sheet would be higher than that, but everything's just notional because for firms such as ourselves, the balance sheet has no meaning because it's fluid. It's notional in the sense that if I give you a simple example in the way the U.S. accounts for things. I mean, the financial statement of a firm which just sort of deals in money and marks to market every day and doesn't make any sense. It's accounting balance sheet is a snapshot at a moment in time. It doesn't tell you anything about what your exposures are. It just tells you what you're holding. It doesn't tell you how a change in factors out there, how a change in the level of interest rates or the shape of the curve or relative prices of U.S. and Germany, etc., are going to affect your equity. How is your P&L going to change? It doesn't tell you anything like that, and so it has very little meaning. If you buy a bond, we buy bonds in the United States, we would borrow against to carry that position. And a repo that creates an asset and a liability. Well, we're not just going to hold that bond outright levered because there's a lot of risk associated with the interest rates, changes in the direction of or change in the slope of the curve. So what we would do is we tend to short bonds or do reverse repos or borrow bonds to hedge the risks of our position. and to concentrate on that part which we deem to be valuable. Well, under the current accounting convention, what that reverse repo does is set up a liability because we sold the bond. So we own the bond, we have to deliver it. But the proceeds from the short sale are deposited in treasuries overnight. So we end up with another asset. So if we buy a bond and sell a bond and lever it and borrow it, we end up with 4 times the balance sheet than we would have if we just went out and bought a bond and essentially held it long. So it doesn't tell anything about how the risks of your portfolio are. It makes it very sort of very difficult for outsiders when they're looking at us or potentially other hedge funds to know what we are doing, our types of strategies. I mean, I tell people what types of strategies tell our clients, our co-investors, what types of strategies we use, and they say, well, they don't tell us anything. Well, it's kind of boring when you tell a story about IBM and you say, I think new management's going to resurrect IBM, and we're buying IBM, and sure enough, new management comes in and resurrects it. Y'all understand that. But when I tell you we're looking at 5 basis points between off the curve, and we're going to buy that and short other instruments and hedge it, and then use leverage to make money, you say they're not telling me anything. They can't be making money that way. I mean, our returns have been very high, but over the last 3 years, we've had very high reward to risk ratio. I think in a lot of ways that those returns have exceeded our expectation, and we had expectations of high returns. We've done better than what I thought we would do. In a lot of ways, because of sort of diversification, what we do is we have strategies in place around the world. So we have strategies in, say, Japan. We have strategies in the other countries in the Far East, but Japan's where the bonds are. So you have most of our strategies in Far East or in Japan, and then we have strategies obviously in the U.S. to a great degree, and then we have strategies in the various countries of Europe, but mostly. So when you have these strategies, the way we run all our strategies is as maybe 20 or 30 strategies. We run them all as sort of independent strategies. And so essentially, strategy in Japan is uncorrelated with the strategy in the Bund, say, in Germany. And so that if each is self-contained and hedged, you end up with a portfolio of 20 different strategies, which through diversification reduce the risk quite dramatically of what your return experience is going to be. So if we lose in Japan, take a U.S. manager, a small manager. We might not be the most expert in running, say, a mortgage strategy in the U.S. There might be better people than us that run the mortgage strategy. But they have 3 or 4 people. They're all in studying the mortgages and involved in that strategy. Well, if you have losses in the mortgage strategy where behaviorally or institutionally the strategy diverges and doesn't converge, then it's the case that it's out there to see and have all your risks there. So your client doesn't understand whether it's luck or skill which caused you to lose money in the mortgage strategy. With us, we have, because all of us are involved in risk management, risk control, we are actually running 20 strategies around the world. And so that if we tend to be losing, say, on the mortgage strategy, it could be either that we missed something in our models and that we took a permanent loss, or there's a behavioral effect or an institutional effect which caused the future expected returns to be higher in the mortgage strategy than currently for the risks involved. And so we could dynamically allocate resources around the world. So we move money, say, from bunds to mortgages. And you think about some of your own allocations. If you gather your portfolio managers in at the end of the year and ask them all in the same room and asking them what their opportunities are and whether they should allocate money to each other, you get very blank stares as to what to do because no one could figure out what all the other people are doing. So we gain that lack of friction, that we can, as opportunities develop, we move our money from our various strategies, and that enhances return. Doing an optimal asset allocation among the strategies also helps us in terms of maximizing our return. So our volatility, if you have diversity in strategies, your volatility is much less, even though you're using a lot of having a high notional balance sheet or having what the conventionally is called leverage. So for us, that's very important. But also it requires a certain scale of assets to do what we're doing, which is different from the person who's running a $300 million mortgage portfolio. With a $300 million mortgage portfolio, well, let me give a different analogy. We invested in Italy, and we have over the years, because volatility is our friend, and when there's a lot of uncertainty, that adds to the ability to analyze, and a lot of different things happen that cause you to have divergences between the values you observe and what you think would be equilibrium values. So you get a country such as Italy, and you're a U.S. manager. The Italian bond market is 99% owned by Italians, and very few foreigners own Italian bonds. Well, if you have 3 or 4 people running a business in the United States, it's very hard to devote the research effort and time to really understand all the vagaries of the various bond instruments in Italy and understand which are mispriced relative to each other and how to value those. Also to be able to take the positions within the country that would allow you to have diversification because you're across the whole spectrum of assets. So we have about 120 people working with us, and it needs size to be able to do that. So it's different. I mean, you could have a small proprietary manager who is just in Italy and concentrated in Italy and understood Italy. You could have one that was just concentrated in JJBs and the various other markets in Japan. Yet for us, it's a different focus. We need people. We need researchers. We have to spend lots of time being in these countries, getting to know the people, getting to know the institutional rigidities and details and how the markets work, as well as being able to apply our model. Because one of the things you always know when you have a model is if you apply it and it says, my God, you just hit 75 home runs, you start getting really worried that you've forgotten something. And the model only gets you, some model's only a tool that gets you partially the way there. Even though people argue about leverage and the use of leverage, we tend to sort of have 3 principles at our firm that are really crucial. One is that unlike banks or other financial institutions, we mark all our positions to market each day and report each month. We have it by outside marks only, so we use external pricing services. None of our internal models. And that transparency says that we know all in terms of our risk management. We know in terms of our P&L is a true P&L. In other words, what it really is a change in the value of our fund each period of time. Unlike others who, if you look at Citicorp, for example, not to be critical, but their earnings is just whatever they report according to accounting convention. It really doesn't tell you what the true economic earnings were or the true P&L was for that period of time. We try to manage to a targeted risk level. And if you are in arbitrage, you can really be at any risk level you want, depending on whether your positions are scalable or not. You take in other investors along with you if your positions are scalable. If your positions aren't scalable, you don't need other investors because you can just invest your own money, essentially. So that's the risk reduction part of it. The other part of it is if you're a great asset and liability manager, you have to also be able to be a good working capital manager. And for us, managing working capital is much more important than a targeted risk level, because we get the targeted risk level almost automatically through the strategies and what they allow us to take. There's only so much you can take in our Japanese strategy, for example. There's only so much you can take in the Italian strategy, because when you take positions, you also have to worry about not only the cost of getting in, but also the cost of getting out of positions and your effect on market prices and the timing. But if you have a balance sheet in which you're holding assets and you have leverage, you're using leverage, then your capital that you have is your working capital. It's essentially your assurance money. It's one thing to have great ideas, but the markets turn against you. The behavioral, institutional conditions come up where you'd like to be able to hold your positions, but you can't because you have to start reducing the size of your balance sheet. So for us, the ability, and others, I presume, to be able to model what the working capital requirements are so that if it were necessary in a chaotic situation or crisis situation to reduce the size of your balance sheet, you can do it in an orderly fashion under the terms you want. Because most times when you have a leverage situation, what you find is that when you have to reduce the size of your balance sheet on other people's terms, you tend to sell your most liquid assets first. Why do you sell your most liquid assets first? Because they have the lowest transaction cost, and you have an option to get back. In other words, you don't want to incur huge transaction costs to proportionally reduce the size of your balance sheet, and because markets could come back. If markets keep getting worse, you're in a worse position, because what happens is you sold your liquid asset, but not only now have you suffered losses, but you're completely unbalanced and you only have the liquid assets left. So for us, managing the liability structure and how we tend to model that, think about how much capital we need as a theoretical working capital is just crucial, because we have our money invested here, and it's no good to say that we have tremendous opportunities in the future without having any capital to invest. So I think I'll stop there, but basically I think that when you talk about arbitrage funds, it's the people, the way they tend to think about problems and their skill sets and applying them. There's many different venues, many different vehicles, and each can be successful in their own ways. As you probably know better than I, because I don't talk to that many other arbitrage fund managers, that there are many more differences than there are similarities among the various fund managers. Thank you.
Thanks, Ron. Myron and I haven't had a chance to decide who would talk about the art and who would talk about the science of arbitrage. I would only point out that Myron probably can figure out the square root of 19,772 in his head. I certainly can't, but I think arbitrage is a blend of art and science, and maybe a little bit more art. At least that's our point of view. This morning, I'm going to be talking about the state of the arbitrage business, where the deal activity is these days, and some of the challenges and opportunities that we face as arbitrageurs. And as Ron indicated, I do have a handout, and you're welcome to follow along. I would say, first of all, that this has been adapted from a slide presentation. That's why the type is so large, not because I think you have poor eyesight, but bear with me, and we'll walk through this. I know many of you are highly familiar with merger arbitrage, but just so that we're all on the same wavelength, I'd like to define terms. I'm going to be talking about merger arbitrage, not convertible arbitrage or distressed securities or special situations, or all the other kinds of arbitrage that are out there. As merger arbitrageurs, we invest exclusively in companies involved in publicly announced corporate mergers, takeovers, and other corporate reorganizations. We buy these securities at a discount to the deal price, to what we expect to receive if the transaction in question is successfully completed. There are two reasons why we can buy takeover stocks at a discount. I'm sure you're all familiar with the time value of money. The average corporate merger takes 3 or 4 months. And of course, not all deals are completed, although about 90% of publicly announced transactions are completed as fewer are terminated, and the arbitrageur has to be compensated for the risk of the broken deal. I've got a table here that shows some of the things that we look at. It's called Analyzing the Deal, the third page in your handout. I'm not going to spend a lot of time on this. Again, I think most of you have at least a general idea of what arbitrageurs do. I will say that contrary to some misconceptions about the business, we don't invest in everything that's announced. In fact, many of us are very selective. And the considerations that we focus on, some of the more important ones are listed here. I just want to spend a minute on the very first consideration, the strategic rationale for the transaction. We think that's the single most important thing to focus on. We want to know why the target company has chosen to sell at this particular point in its corporate life cycle, and why the acquirer wants to buy the target. We want to know how highly motivated the parties are, because we've seen deals survive all sorts of unexpected difficulties simply because the companies were so highly motivated to complete the transaction. Conversely, we've seen some deals break up at the first sign of trouble because the parties weren't that highly motivated. So this is the single most important thing that we focus on when we hear about a newly proposed merger. And we talk to the companies involved and Wall Street analysts and industry consultants to get a handle on how highly motivated the parties to the transaction are. We, of course, look at the status of the transaction. Do we have a definitive agreement or just a letter of intent? Where do we stand? Are there regulatory issues? These days, with all the strategic mergers involving companies in the same industries, we spend a lot of time on antitrust analysis. Special conditions, are there earnings tests or book value tests that have to be met before the deal can close? And timing, of course, is very important to an arbitrageur. It really doesn't matter to us how long it takes to complete a deal as long as we're paid to wait. We, of course, look at the downside, what happens if we're wrong, and we put it all together and look at the rate of return and see if it meets our hurdle rate for that kind of transaction. So that's, in a nutshell, how we look at deals. Unfortunately, there have been a lot of deals to look at, as shown in the next chart. I think this is pretty interesting. We show the total dollar value of M&A activity involving U.S.-based target companies by quarter, going back to the first quarter of 1991. You can see that through the first half of 1996, merger activity is running at record levels. Although the targets in this particular data series are all U.S. companies, many of the buyers, of course, are foreign companies. It is a pretty inclusive list of deals. I thought you might be interested in what our portfolios look like currently, broken down first by type of deal, and then type of acquirer, the terms of the transaction, and finally economic sector. The data that's shown in the next four pie charts relates to the merger fund, our domestic open-end mutual fund, and it's roughly 50 positions that it holds. And I think this first chart is interesting. We show by type of deal, and there we're distinguishing between friendly and hostile transactions, and you can see that the overwhelming majority of the deals that we're invested in currently are friendly. Although I would note that one of the most interesting things about the arbitrage business in the last few years is the increasing number of hostile transactions initiated by blue-chip American companies that 10 or 15 years ago would never have considered doing a hostile deal. For example, IBM, Johnson & Johnson, Union Pacific, American Home Products, and just yesterday Norfolk Southern have all engaged in hostile takeover attempts in the last few years. And what that says to us is that corporate America increasingly sees strategic acquisitions as critical, as they're so important in achieving some key strategic objective that the companies are willing to engage in hostile transactions. The next pie chart shows deal activity by type of buyer, and I think this chart is interesting as well. We distinguish here between strategic transactions involving companies often in the same industries and financially driven transactions, principally leveraged buyouts, highly leveraged transactions. And you can see that, at least in terms of the merger funds portfolio currently, the overwhelming percentage of our portfolio is invested in strategic deals. If we looked at this same pie chart in the late 80s, we would have seen a much higher percentage of financially driven transactions. And I think it says something else. For those of you who are wondering whether the U.S. stock market is richly valued or not, I think this is a really interesting pie chart. In the late 80s, you could buy assets on the floor of the New York Stock Exchange cheaper than you could create them. Today, and as a result, you've had a lot of highly leveraged transactions. Buyout groups were taking advantage of those opportunities and purchasing publicly traded companies at a premium to where they were selling. So you could argue that private market values exceeded public market values. What this chart says to me is that just the opposite may be true today. That public market values exceed private market values, and that's why you have a lot less activity in the highly leveraged sector of the business. And I think that's underscored as well by the next chart, which shows the breakdown of our current arbitrage positions by deal terms. And what's interesting here is that the majority of transactions involve at least some stock. You can see stock with a fixed exchange ratio represents 22% of our holdings. Those are the deals that absolutely have to be hedged to avoid market risk. Stock with a flexible exchange ratio, in which the number of shares that the target company shareholders receive will float with the price of the acquiring company's stock. Those deals represent about 16%. And deals involving cash and stock, 28%. But if you add those first three pieces of the pie, you can see that about 75% of the deals involve at least some stock, which is another way of saying that corporations are in a good position to use their richly valued shares as currency with which to do deals. If the stock prices were at depressed levels, you'd see a larger percentage of all cash transactions. And the last pie chart here shows the composition of the merger funds portfolio by economic sector. Financial services, and in that group we include insurance companies, banks, savings and loans, and mutual fund management companies, continues to be the largest piece of the pie. That's been true for the last couple of years, although this number is down from where it was a year ago. A year ago, financial services would have represented about 40% of our portfolio. The problem is that a lot of the bank deals these days don't offer attractive enough rates of return to warrant our investing in them. Consumer services, retailers, drugstore chains, they'd be included in that category, 19%. Energy, this is interesting. There are a lot of deals in the energy sector now. That was not true a couple of years ago. I think you're going to see a lot more transactions. You're seeing, interestingly enough, in the utility area, a blending of gas companies and electric companies. We're involved in 3 different mergers currently that bring together gas and electric utilities. Business services at 9%, media at 9%, telecommunications at 7%, and you can see some of these other categories. All this data, by the way, is as of the end of September. Risk management, I think, is really important, and to the extent that different arbitrageurs approach the business differently, I think those strategies show up, those differences in approach show up when you talk about risk management. I think to a greater or lesser extent, almost all professional arbitrageurs practice some of these risk management techniques, but there is a growing divergence, I think, in terms of strategies in the arbitrage business with respect to some of these things. But first of all, a lot of people, again, have always thought that arbitrageurs are chasing rumors. I think most of us who do this professionally don't. I know we spend 0 time trying to guess the next takeover stock. We're only involved in publicly announced transactions. No excessive leverage. I think that's pretty important. Some of the big disasters that have befallen the hedge fund industry in the last few years with the benefit of hindsight, were due to the use of excessive leverage in market-neutral portfolios. At least they were advertised as market-neutral portfolios, and it turned out that they were only market-neutral in certain markets. And the use of leverage compounded the problem. I think most arbitrageurs are pretty careful about this. Those of us who operate onshore, and we also have an offshore fund, but onshore we're subject to Reg T margin requirements, so we could never be more than 200% invested, and that includes our longs and shorts combined. No concentrated positions. I think, again, most arbitrageurs practice this risk management technique. We're in 50 different deals currently. We would never bet the ranch on any one transaction because it's too painful when deals break. No matter how well we do our homework, no matter how carefully we look at a transaction, we're going to make mistakes, and we don't want one deal, the failure of one deal, to decimate the portfolio. And finally, no directional bets. And I think this is where, by this I mean, if it's a stock-for-stock deal involving a fixed exchange ratio, at our shop, we're always short the acquiring company shares in exactly the right ratio that's called for in the merger agreement. I think there's been a tendency in the arbitrage business lately for some managers to try to squeeze out extra returns by making directional bets when it comes to hedging. For example, if an exchange ratio, WorldCom is in the process of buying MFS Communications, and the terms call for each MFS share to be exchanged for 2.1 shares of WorldCom. Well, we're at a 2.1 hedge ratio. We're short 2.1 shares of WorldCom for every share that we're long in MFS. We're locking in our arbitrage spread, and it doesn't matter to us in that posture what happens to the stock market generally or WorldCom in particular. But WorldCom stock dropped a lot on the news because of the dilution involved, and some arbitrageurs say, well, I think that was an overreaction. I think the stock market looks okay, so instead of being short 2.1 shares of WorldCom, I'll be short 2 or 1.75. That's what I mean by a directional bet. In a bull market, if your bet's a bullish one, that's going to enhance your rate of return. Obviously, if you guess wrong, it's going to reduce it. And I think you are seeing different people in the business approach this slightly different, the whole question of directional bets. And we perhaps could get into that more in the Q&A. Finally, I'd like to conclude with a few thoughts on the challenges and opportunities facing the arbitrage industry. My observation here that everyone's an arb is a problem for the business. Not only are there hundreds of arbitrage firms out there, boutiques, private partnerships, offshore funds, and member firms who are doing arbitrage on a proprietary basis. But there are a lot of closet arbitrageurs out there, and we wish they'd just go away. There are, for example, conventional money managers who are, this is a great marketing ploy. You know, if you're interested in buying Nations Bank, you know, I can get it for you cheaper. Just go out and buy Boatman's Bank shares, which is in the process of being acquired by Nations Bank for a fixed number of shares. So an institutional salesman at Keefe, Bruyette & Woods, for example, the bank brokerage firm, might call up an institutional investor and say, look, these deals always get done. There's no question this transaction will go through. You can buy Boatman's Bank shares at a 5% discount to its value in Nations Bank shares. If you want to be long Nations Bank, why not buy Boatman? Well, that's fine. That 5% discount for a deal that might take over 6 months is not adequate. It doesn't meet our hurdle rate, and so we can't play that, in part because of the activities of what we call closet arb. So everybody's an arb these days, and that's a problem. Now, where do you go to achieve an attractive rate of return for your clients? How do you do that? Well, in our shop, over the years, I think we've tended to gravitate toward deals with wrinkles. Everybody can invest. You know, there are a lot of people out there taking a paint-by-numbers approach to arbitrage. when you get on a conference call now, a deal's just been announced, and corporate managements typically hold a conference call first thing, there might be 200 people on that call. In fact, lately, there have been so many people signing up to be on the conference call, you can't even get into the queue. And you hear other ARBs asking these, rote questions. Have you done your due diligence? What regulatory approvals do you need? And everybody else is listening to these questions and listening to the answers. And I think it's hard to distinguish yourself as an arbitrageur, doing it that way. We like to look at deals with wrinkles, where there's an obvious risk factor, where everybody knows there's a problem, but where we think the market has overstated the risks. Just to give you one example, there was a computer software merger last year. Regent Computer was being acquired by Computer Associates, two companies that provide computer software for mainframe computers. It was a deal that occurred just after Intuit's, Microsoft's proposed acquisition of Intuit fell apart because the Justice Department objected to it on antitrust grounds. Everybody in the arbitrage community had antitrust on the brain, and people started to think that Regent and Computer Associates was going to meet the same fate. We sunk our teeth into that transaction and really got comfortable that there wouldn't be a problem, and even if there were, that it could be fixed. And there were 2 weeks before that deal closed, there was an annualized rate of return of better than 50%. It's just an example. We make plenty of mistakes too, but it's an example of a deal with a wrinkle with an obvious risk factor that offered an extraordinary rate of return because everybody was overly sensitized to the antitrust risk with computer software mergers. So there are challenges out there. It's a very competitive business. There's a lot of money being thrown at takeover stocks. But I think it is possible to achieve very attractive risk-adjusted returns if you approach the business in a very systematic, disciplined fashion, and you're willing to be a little bit creative when it comes to deal selection. And with that, I'd be happy to take questions.
Any have questions? Thank you both, and let's open up to any questions or comments that any of you might have. Yes.
I'm just curious, there's three related questions. One is, how did long-term capital management do in the first quarter of 1994? And secondly, related to that, to what extent do you have a concern that the models have been developed in relatively liquid markets? I guess that's probably over in capital management, that idea of cost, but and then pockets of illiquidity developing and the impact on that on safety of how we portfolio.
Well, we started in February of 94, and that because there are transaction costs to put on positions, that we incurred transaction costs to put our positions on, so that I'm sure in the first quarter of 94, because it was a startup quarter and we started in the middle of it, that we had lost transaction costs. That's essentially what happened in the first quarter. Liquidity, it's interesting because you have United States market is one of the more liquid, probably one of the most liquid markets in the world, and so that the spreads are very narrow and the profit opportunities are very small per unit. But it's really, in a lot of these markets, it's not what the spreads are, the transaction costs. What it really is can you get inside the market? Right? Can you get inside those costs? Like U.S., we have over the years a lot of experience in the U.S., and so we've already incurred the fixed costs associated with understanding the U.S. market. So it's not very expensive for us to operate in the U.S. market and eke out a living. Here we don't have to have the silver mother lode. We can mine the old veins, and other people look at us with disdain. But so what? When silver gets to the store, it's still sold the same price. When you go to other markets, such as Korea, for example, or South Korea, you start salivating because you see, you can make 1,000% on the spread. However, it costs you $1,200 to get in. So it's not, there's a trade-off, and there will be over time, if you have chaotic situations, a change in liquidity. So everything else being equal, we would not be buying we'd be buying slightly more illiquid assets than we would be buying liquid assets, because that makes most logical sense. So if there are flights to liquidity, spreads would widen, and we would take losses potentially in our positions. My expectation would be such. And that's why working capital management is so important, because if people are willing to pay you to provide liquidity, you can make money. It depends on your staying power. I mean, some people should be in the overnight money markets where they have all the liquidity they need, and people want to pay for liquidity. If what I find is many institutions are just in the wrong clientele. They don't need liquidity, but they have all their money in liquid instruments, overnight instruments, or very short-term instruments. And so what we would tend to do is, what that tends to do is create a huge supply of liquidity and not as much a supply of illiquidity. And so it's true that you have to have staying power in those times, but you can make the most money at those times as well. So we don't mind losing money. I mean, it's one thing is that our greatest trades have been we've had small amounts of a trade on, and then we've actually lost money. Unlike other strategies, like when you buy the stock market or where you buy bonds, if the market goes down, you lost. It's most likely the market is going to go up as go down from there. Sort of a random walk type of theory. It doesn't seem to have much of a memory. But our opportunity set is not constant. What happens, it changes over time. So if we lose on a trade because the spreads widen against us, and the animal spirits have whispered to us that our model is correct and the parameters are correct, so those nice, so that they're on our side. Essentially, what that means is our loss is going to be followed by a gain, so that we have autocorrelation in our returns. And so that adds value. It's much different from investing in strategies where you're long market factors, because they don't seem to have memory. When you're doing trades that are model based, which have date with destiny, then they'll have to come back if you're right. I mean, obviously, the way we lose money is if we're wrong. We left out a parameter in our model, and the market knew more than we did and essentially diverged against us, and we lost money.
Both of you touched on a similar theme. You're both trying to avoid the market risk, the general risk that's out there, and pick up those nickels, perhaps with a vacuum truck, or perhaps by skirting around those conference calls. But what's your assessment of the risk of a more system-wide failure of institutions or a true disaster scenario, and how can you or do you protect against that circumstance? Particularly if you're working in markets that obviously may have been liquid that become illiquid.
Well, I don't know whether we want to protect. I mean, I love that. I mean, the point is, to us, it's like some people are pessimists. I guess we're optimists, but volatility is our friend, because in a lot of ways that if you have very quiet markets, term structure interest rates are flat, things are great, and that there's not as many interesting divergences that occur. And for us, the idea of chaotic markets, everyone goes into their shell and back into their own knitting, and leaves the convergence trades or the relative value trade market to us. It's a peak load pricing problem. When everything's quiet and nothing's doing, you come to breakfast. When the market's chaotic, you wouldn't be coming to the breakfast. There'd be a lot of cancellation. So I mean, that's the same thing. We want cancellations. We like to talk to no one. Have no one to breakfast. So I mean, that's essentially by way of analogy.
Maybe Canada can develop a breakfast index.
That's right.
Market sentiment.
That's right. Exactly.
And Fred, from your point of view, is volatility, is chaos your friend or your enemy?
Well, there are windows of opportunity in this business, just like Myron's business. We run a slightly less levered portfolio than Myron. We're carrying assets a touch short of $120 billion. But it's real important. we want to separate deal risk from market risk. If we're right on the deal, if the merger gets done on the original terms, we want to make money. We don't want to lose money because we didn't hedge against market risk. So as I said earlier, in a stock-for-stock deal, particularly a stock-for-stock deal involving a fixed exchange ratio, we're short the acquiring company. So we're really indifferent as to whether the market goes up or down. If we're wrong on the deal, we'll lose money. We don't want to be lose money because we failed to hedge against market risk.
One thing as well, just the final thing is saying, I mean, we don't think we should get paid for just holding the market. I mean, anyone get paid for holding the market. You want to buy an index fund, you go to Vanguard or whatever, and you get one, or other firms, you get one very inexpensively. That's a commodity product. Or you want to hold bonds. I mean, anyone can hold bonds. So we think we should get paid for adding value to what other investors could do. Now, we would take directional trades. I'm not saying if it were the case that we really thought that the market was undervalued, the bond market in particular was undervalued, we would go long that position. But what we tend to do is we have to have a consensus. We don't have a guru system where one person is doing that. We don't have a George Soros or whoever he delegates to make those bets. And so to really do it, it would have to have a consensus of all the principals on the risk committee to take a long position. It's much harder, if we all sat around and thought, where's the stock market going to go from here? And, a lot of us would say up, a lot of us would say down, and some would say, I don't know. So it's hard to get a consensus when you're doing directional trades. So you have to have one person that somehow sleeps well and gets the message. But so we have to really have some do it. So we want to get paid by sort of adding value and not just by doing things that other investors can do for themselves.
Look at it.
Aside from the political incorrectness of the term volatility of our friend, I think that has been true for market makers for generations. That's not new. Contrast with the merger activity, which would suggest that when you get market instability, the actual risks dramatically go up, and those are reflected in the wider margin merger spread, where the risk of deals breaking as a result of precipitous moves in stock or bond, in fact, change the game measurably. So where I would totally agree that volatility is our friend, irony is that, for example, I know it suggests that merger arbitrage volatility might do it clearly.
Well, that's an interesting observation. On October 19th of 1987, we were faced with a little volatility. The Dow down 500 points, and takeover stocks really led the market down. They did as worse or as badly as or worse than the rest of the market. And arbitrage spreads absolutely widened dramatically in the fourth quarter of 1987. We'd never been through a period of market dislocation. None of us in our generation had anyway. And there was a lot of uncertainty as to whether these deals would in fact get done or not. And the real interesting thing about the crash of 87, it stress-tested strategic mergers. And the vast majority, with the exceptions I could list on the fingers of one hand perhaps, these deals all got done. A few were renegotiated. A number were delayed. But virtually all of them got done, which is why arbitrageurs like strategic deals. And our best year in history was 1988. Particularly the first quarter of 1988 was our best quarter in history, because what happened was when the dust settled and it became clear that these deals in fact had survived the crash, the spreads converged. And we were looking at deals with 20, 30, 40, 50% annualized rates of return in the fourth quarter because of the uncertainty. When it became clear early in 1988 that these deals would get done, those spreads collapsed, and we had a windfall in the arbitrage community.
We were looking at some managers recently supposedly market neutral, and if you look at them on the basis of, say, the standard statistical populations over time, you're seeing volatility is there right now. You look at breakfast, where you look at indices and you look on a delta and gamma basis, especially the past year, 18 months, those have gone off the charts.
I'm sorry if I said I didn't say it's not volatile now. I'm just saying that if it's the case that I think it has been a volatile period of time. I was just doing it in a stylistic sense, so I wasn't really referring to today. I was just kind of by way of analogy that if all of a sudden something chaotic happened in the market this morning and you heard it on the news, or Europe was in a mess, or Japan was in a mess, maybe a lot of people would be canceling the breakfast. That's all I meant.
The common effect just seems like, especially last year, volatility has gone up tremendously, and from multiple strategies we're looking at really are more.
It has been. There has been a lot of volatility. I would say would like to have had more volatility, but it has been volatile. I'm not going to predict what it's going to be for the next period of time.
I would just observe that the stock market, the markets in general, are just like everything else in this country, whether you're talking about corporations or global markets, just becoming increasingly competitive. And it's very difficult to sustain above-average risk-adjusted returns over a long period of time, because these pockets of inefficiency are just that. They're pockets, and they get exploited. And there are cycles to investment styles. They go in and out of favor. There was a time in the early 90s when there weren't many mergers and takeovers, and a lot of ARBs decided to get into convertible arbitrage or special situations or other things. And it's just really, really difficult. You've got to, I think, stay focused and be better at what you do and control risk better than your peers. But I'd just like to make one comment about the whole question of transparency. I think some of these disasters that I referred to earlier that have befallen the hedge fund business could have been foreseen if the advisors had shared their portfolios with their clients. I think the issue of transparency is very, very important. It's very difficult, if you're on the outside, to know exactly what your money manager is doing with your money. And it's a lot easier if you knew the kind of leverage that was being used and the kind of positions that were being held. And I admit that in the more esoteric areas of the market, it would be very difficult, perhaps, to assess what the real risk is. But I think it would be helpful. And I think some of the disasters have happened because managers have strayed from their mandates or were playing a different game than their clients thought they were.
I mentioned something earlier about a lot of people moving to the outside business and doing arbitrage. It's the same thing for me, arbitrage across the board. At LPCM, you mentioned earlier that you take directional bets. That seems pretty amazing returns in the last couple of years. Now, what I would consider arbitrage is related returns even on a levered basis. Is that something you took advantage of in 94, 95, or how directional has you all become?
Well, I think that the vast majority of our profits, overwhelming amount of our profits, have come from relative value and convergence trade, not from directional.
So when you see an opportunity out there, you're not necessarily
No, can't. There's no way that our strategy, the way we run things, would allow that to occur.
You see those spreads starting to compress in different areas that you've got involved in. Obviously, you're all over the map. But
Right.
have you seen a change in the last few years?
Yeah, that's how we made our money. They converged. There's a lot of strategies that we're involved in converge. And one of the things to say in Fred's case, you see, which is interesting to me in terms of transparency, it's easy for him to say that you could be transparent because once a merger deal is complete, it's very unlikely that the clock will rewind itself and it can start it over again. But for us, what goes around comes around, so that when something converges, we'll start reducing our position and get out of it, and then it might go the other way. It might become overvalued, so we could reverse our position, and conversely, it might go the opposite way. So we can show our balance sheet. We show our balance sheet is just meaningless. And there's no way that one can figure out from our balance sheet, if we told you every asset we held, which we do, what types of strategies we're in. I mean, you'd see we're in bonds, or we'd see we're in U.S. bonds or gilts or whatever else it happens to be, but it wouldn't be possible to determine from a balance sheet what we're doing, and we don't divulge the past successes in consummate detail simply because that's our toolkit. What goes around is going to come around. So you're right. I mean, there's an agency problem when you deal with us. People have to trust us more so than maybe they'd have to trust Fred, who's more transparent in what he does. And as you say, we could deviate from our strategies. But one of the nice things that comforts our partners is we have so much our own money invested in this, and that's a great motivator. It motivates the amount of risk you take, and motivates types of strategies you're in as well. I think when you look at some of the disasters, I think you look at as a fraction of the funds. These people have held no money in the fund. It's in everyone else's money. I very seldom would like to have a partner where it's 99% is my money and 1% is their money. 99% is if I'm giving the money, it wouldn't be the case if they have 1% and I put up 99%. You mean behavioral arbitrage? We haven't done any of that. No. Well, you see, the trouble is when you define these words, the reason I'm hesitating is because it's what English says and what people do. We have models. Now I don't know what some of the model parameters are statistically based. And so we use model strategies. I mean, in some sense you might call that as being statistical arbitrage. But then when I listened to what your parenthetical, I knew it being particular to say that there's a sequence of past prices that when you get deviations, then they have a tendency to rebound, and we don't do that type of behavioral. That's sort of behavioral arbitrage, we call it, but we don't do that.
That's a term. You don't do it.
No.
Any reason why?
Well,
do you disagree with it?
No, I don't disagree. The only thing we try to do is worry about the tail probabilities. In other words, something that you do behaviorally works 9 times out of 10. It was when I first was in the option business. Lou was there as well. But the idea is you have a situation where you ask the traders what they do, and they tend to sell options. Why do they sell options? They sell options because they can't go home to their spouses and say, you didn't make any money tonight. So as long as you sell options and the market doesn't go against you, you're going to make a lot of money because you make a lot of nickels, right? I shouldn't just keep using the nickel now. You make a lot of dollars, but occasionally you take a big loss. And that's the trouble with behavioral types of arbitrage. That what haven't you considered? What is the time? Is it that there's a small probability of taking a big loss? Many times you'll make a large probability of making a small gain each period of time, but occasionally you'll take a large loss. And that's one of the difficulties with the behavioral arbitrage. But I'm not against it. When we put on a new position, does it have a positive reward to risk ratio? And what I mean by that is, I'm being very careful in that, is that does it, considering transaction costs of getting in and out of the position, plus the accounting costs and everything of the position, does it add value for the portfolio? In a risk-adjusted sense, in other words, being market neutral.
As a result of the general partner's increase, have you reduced have you changed the risk level of the portfolio over the last 2 years?
Our anticipated or targeted risk level has tended to fall just as the size of the portfolio has gotten larger, that the risk constraint has become less and the working capital constraint has become binding.
Myron, I believe you mentioned that you started the firm in February of '94, and that your return expectations have been you've exceeded them so far. I was wondering if you could tell us a little bit about how you've done since you started the firm, what your return expectations were, and to what degree they were based on the success of the model and practice, or the things you did, at Solomon or prior, in any prior experience, and how it had done at that time period. And then I know it's sort of the same question to you, Fred, in terms of, I believe that you mentioned that you started the firm in 1980. Just wondering if you could tell us a little bit about the returns since you started.
My returns were lower.
When I went to talk in Japan, gave a talk in Japan a number of years ago, and the Japanese are very polite because they ask you 25 questions, and in one question, so you have 25 questions. So there's no way you can't fail to answer one. Well, the answer to your question is yes. Not to be compensatory, but the idea in terms of talking about funds, or in general, I sort of use our sort of style as a way of doing things. Our returns have been what they are. I mean, the way I characterize them as I think they've been greater than expected. And I said why they were greater than expected because we happen to have much better diversification. Initially, I thought we'd be constrained by the risk levels. As we opened the fund up, we thought we'd have to concentrate more in the U.S., and we're able to develop our skills and apply our technology in both Asia and Europe, which reduced our risk and therefore made our returns higher than the levels we had anticipated, because we can take larger positions through the diversification. That was a process, other than in terms of that's what happened evolutionarily. We've had positive expected. We realize returns in a Sharpe sense that have been excess returns have been about a Sharpe ratio around 3 over the last since inception of the fund. That's market neutral, and that's factual.
Our Sharpe ratio in the last 3 years for the merger fund was 2.8, which is the highest Sharpe ratio of any equity mutual fund in the United States.
One more question.
Myron, can you talk to some of the pattern and persistence of institutional rigidity that creates some of this crisis? Try to exploit how you protect the model for that?
I guess sort of the interesting thing to me is I'd like to take a central banks in Europe, okay, as an example. Central banks in Europe, which hold their reserves, tend to be holding overnight money, or very short-term money, which is one of the most ridiculous applications of excess wealth that I've seen. Okay, that adds opportunities, because instead of them providing liquidity to their markets by holding instruments they should be holding, essentially we can buy the instruments they should hold and borrow the money from them overnight. Is that just one illustration?
Well, I want to thank both of you very much for all of your very interesting and illuminating comments. One more question?
Yeah.
Oh.
Please.
Myron,
Oh, sorry.
when you run a fund of funds, we have about 18 hedge funds. The Sharpe ratio goes from about 0.8 to about 2.6.
Of the constituents?
Of each,
Yeah.
When we put them together, the Sharpe ratio for the total package is about 4.5. And we have a constant argument about whether we should add more funds or reduce the amount just on an absolute basis. It seems that when we add more, the Sharpe ratio really seems to go up. I haven't added so many that it started to go down. But you seem to get a different amount of optimal managers if you just look at it from the Sharpe ratio. I don't know.
Well, it's a very interesting question. But you're trying to satisfy a set of customers, and we are providing a product which customers marry with their other products. So your business is different from ours. And the interesting thing is that also it depends on your clientele mix and what risk level they want. In theory, what you should do is always try to attain the highest Sharpe ratio and then allow your customers to lever their position. But the problem is if the customer levers their position, there's transaction costs and all the other borrowing costs, and you come about with the ability to lever the position. So you have to trade off those frictions against the optimal Sharpe ratio. So the Sharpe ratio is built in a world in which you have no friction, no cost to change the scope or scale of your portfolio. For example, if you manage money for a pension fund that can't use leverage, or it's a huge cost to using leverage, then the risk level might not be appropriate. I'm not sure, but for that particular client. So in theory, what you should do, if I were doing it, I would have your asset mix being fixed at what you think is the optimal mix, and then having a CBO or type of tranche structure wherein clients who want different risk levels and different fee levels essentially could go up and down the spectrum.
Pretty well. One last
Yeah.
comment?
Since I don't think you're invested with us, I would absolutely encourage you to look at adding new managers.
On that note, thank you all very much for attending today's breakfast.